Welcome to AHA Math and Science. In today's video, I'd like to talk about one of the really important indicators that I think that really matters to the market. And it's kind of tied to this inflation picture that, at the present time is kind of really, um, one of the important thing that determines, how the Federal Reserve will react and also, changes, how the market will kind of perform. So in I guess like few months ago, maybe in April, March, I talked about this consumer price index for all urban consumers, or the CPIU index. And this is a curve, kind of shows how it has kind of, run for the past 100 years or so. So from a low value of like a 10, in January 1914 to, present time, which is more than 300. This was the data last time I took, which is March 2023. You can see that it really kind of increased a lot. So it's almost like a 30-fold increase. And which is basically kind of reflects, the price that consumers are paying for the goods and service. For example, a loaf of bread costs around like 7 cents, 100 years ago. Actually, no, this is like more than 110 years ago. Today, a loaf of bread costs actually more than like $3, maybe around $3. Depends on the type of bread. So this is just like one example of kind of showing us how the price of things have changed. And this is certainly kind of important. And I actually talk about that, the annual rate or the annual change of the CPIU in that same video. For those who are interested, you can actually take a look, which is called the trend of inflation, that video. As you can see here, that the kind of the average inflation is really perhaps around 2 to 3%. But it really kind of fluctuates. And look at this curve. I spotted kind of really these big cycles. I call these inflation super cycles. And that first one actually happened from 1920 to 1965. And the peak of the inflation during that period was reached in 1947, was actually around 20%. It was even higher than the peak in actually the next cycle. The next cycle kind of started from 1965 and ended around the Great Financial Crisis, 2009, 2010. And you can see the peak inflation was around 1980. That was about 15%. So it was actually lower than the 1940, peak inflation. And now I think we kind of started in the third cycle. But you can see that in each of these super cycles, you have these small sort of like cycles. Like there's another small peak here, and inflation goes up, come down, and kind of like a tide of waves, and the wave get bigger and bigger. And also you notice all these charts, like the lower inflation times during the super cycle, and that bottom's kind of continue to rise in each of these super cycles. And same thing happened in the next cycle. You can see that kind of the annual CPI rate is kind of continue to make high lows. And that's really kind of typical of these super cycles. And the present time, you can see we can already see these two kind of periods of coming up and going down. And then the bottom is kind of also rising. So we really think this is we're kind of in this third inflation super cycle in a period where inflation really kind of runs hot. And this is something obviously we have to really keep in mind, because that's going to change the landscape of investing quite dramatically. And in addition to the CPIU index, actually, there's another index, which is really kind of interesting and also important, because that's what actually the Federal Reserve, which sets the money policy, that really cares. That's the personal consumption expenditure price index. And in particular, it's the personal consumption expenditure excluding food and energy, which is called the core PCE price index. And this is obviously kind of interesting. And you can see in the past 3 years, it was rising very sharply. and then just kind of recently start kind of plateau a little bit or kind of softening, or the rate is no longer as fast, as quick as previous years. So that's really kind of encouraging. In fact, just last week, the latest, the U.S. core PCE price index, which is obviously, as I mentioned, the Federal Reserve's preferred gauge to measure inflation, rose by 3.9% annually in August 2023. This is actually was the lowest level since May 2021. And the market was kind of buoyed by this, this reading of the PCE. And I guess you can see that from the market reaction from Wednesday, Thursday and Friday. So this is really kind of encouraging because the PCE price index was kind of running hot for quite a while. So if we take a actual look of not just price index, but the annual rate of change, and this was showing here on this plot, you can see that it's become very clear. And basically the average value of this annual rate change is about 3.24%. Now the Federal Reserve was targeting around 2%. So in fact, you can see that the average is quite high compared to the Federal Reserve's target. And what is really kind of notable is you can see it has a highest reading basically in February of 1975. It went above 10%. That's well above the 2% target set by the Federal Reserve. And then in July of 2009, it got to a low of about 0.6%. And that was here. But a lot of the time, you can see that in the past 2 decades, from around like late 90s to almost like 2020, it was kind of between this level of 1% to about 3%. The low was around 1%. The high never actually went above 3%. However, during these high inflationary periods, you can see that the peak obviously well above 2%. It's almost reached like 9-10%. But also notice the low here. The low was actually never go below. It just slightly dipped below 3%, but never even kind of get close to 2%. So in fact, you can see clearly kind of this bottom here, which is around 2.8% during these high inflation periods. So if you look at the chart now, you can see that we had a very quick rising in the core CPE at the PCE annual rate. And then just recently, from this was the August data, it dipped from 4.3 to now 3.9. That's really big news. That was very encouraging. And so it gives investors confidence that the inflation is indeed coming down. And since this is kind of the preferred measure of inflation by the Federal Reserve, so this probably can translate to the monetary policy, and I guess at the bond market now is perhaps not that so sure that whether the Federal Reserve will do another rate hike this year. So that's going to be very positive. In fact, from all these peaks you can see here, whenever you have a quick rise, you always have a coming down. So in other words, we suspect this will continue to come down, and perhaps it's going to reach a low around the 2.8%. But since we are not kind of in this high inflation period, I doubt you will actually get to the low of like 1%. Because we are not no longer kind of in this past 20 year period where the inflation is low. So we are totally in a different regime. So in these high inflation periods, we'll be lucky if we can get to like below 3%. And after that, there's a high chance you will actually start kind of bounce back up. And this is when we really have to be cautious, because this will force the Federal Reserve again to be kind of become hawkish, and perhaps even hike rates even more. And that would be really bad news for the stock market. So this is, I think, this is the most important sort of curve and the indicator that will determine the monetary policy will in fact really kind of sets everything. As soon as the federal funds rate changes, then the price of money changes, and it's going to affect everything and the stock market suddenly. And so this is one of the indicators I think it's really kind of worth watching in the coming months, in the coming years, and perhaps even in the coming decades. But for the kind of intermediate term, in the next few months, I'm optimistic that the PCE price index will continue, the annual rate will continue decline, and that will be positive for the stock market. So I hope you have enjoyed this video and find the information presented here kind of interesting. Your support really kind of is the motivation for me to continue make more videos, interesting videos, and share my analysis with you guys. So please make sure click the like button and also click the subscribe button if you have not done that. And it's your support that really kind of keeps me going. So thanks a lot for watching this video, for the auto support that you have given to this channel, and have a great weekend.